Hey guys, I am Deric. Welcome to my channel. In this video, I'm gonna explain to you the basic concept of bonds. Bond is a type of long-term debt instrument, or long-term liabilities, or publicly traded IOUs. It is also called fixed income securities because the interest payments are fixed amounts. For purchasing bonds, investors will receive two types of income from the borrower or the issuing firm. First, principal repayment. Borrower agrees to repay a fixed amount of principal at a predetermined maturity date. Second, fixed interest payment. Borrower agrees to pay a fixed amount of interest over a specified period of time. For most cases, bonds are issued by private entities, corporations, or government. Why invest in bonds? First, they can provide current income for conservative investors. Because bonds pay regular interest payments to the bondholders, so it is suitable for those conservative investors who prefer receiving stable return. At times, they can provide capital gains for more aggressive investors. For example, if interest rates decline, the market value of existing bonds may rise, allowing investors to sell their bonds for a profit. Some types of bonds can provide tax-free income, such as municipal bonds. Tax-free bonds are attractive to those investors who are in higher tax brackets. Generally, bonds can be used for capital preservation and long-term capital accumulation. This picture is a sample certificate of a bond. The Dow Chemical Company, this is the name of the issuing firm. $1,000, this is the principal value of the bond. It's usually called par value or face value, to be paid to the bondholders at the maturity date. 7.625%, this is the coupon interest rate. Taking 7.625% times $1,000, the par value, it means the bondholders will receive coupon interest payment of $76.25 every year. July 1, 2003, this is the maturity date or due date of this piece of bond. Corporate bond is one of the most common types of bond. When you buy bonds, you are basically lending money to the company. In other words, issuing firm borrows money from you by selling bonds. So bondholder is the lender, issuing firm is the borrower. Bondholders invest in the bond issued by issuing firm by lending money. So bondholders may expect to receive interest periodically, which is commonly semi-annual or annual payment, and receive principal at the end of maturity period. For the issuing firm that borrows money from the bondholders, it promises to repay interest and principal under clearly defined terms, such as when to pay and how much to pay. The following are some key features of a bond. Coupon, this is the amount of annual interest income. Just multiply the coupon rate by par value to get the coupon payment. Par value, the amount of capital that must be repaid at maturity, also known as face value or principal. Maturity date, the date when a bond matures and the principal must be repaid. Current yield, a measure of the annual interest income a bond provides, relative to its current market price. Yield to maturity, the yield or return earned on a bond from the time it is purchased until the maturity date of the bond. It is also the discount rate used to value a bond. Call feature, it allows the issuer to repurchase the bonds before the maturity date. It can be freely callable, means anytime the company can buy back the bond. Non-callable, means the company cannot retire the bond until maturity date. Or deferred call, which is a provision that prohibits the company from calling the bond before a certain date. During this period, the bond is said to be call protected. Issuers will exercise the call feature when interest rates fall. So the issuer can refund the issue at a lower cost and issue new bonds at a lower rate. Call premium, this is the amount added to bonds' par value and paid upon call to compensate bondholders. Call price, the bond's par value plus call premium. Certain bonds also come with conversion feature, in which the convertible bonds allows bondholders to exchange their bonds for a specified number of shares of common stock. Bondholders will exercise this option only when the market price of the stock is greater than the conversion price, which will provide a profit to bondholder. Next, let's talk about the relationship between interest rate and bond price. The behavior of interest rates is the single most important force in the bond market. In other words, bond market is mainly affected by the interest rates. Interest rates and bond prices move in opposite directions, which is a negative relationship. When interest rates rise, bond prices fall. When interest rates drop, bond prices move up. That's why bond markets are bullish when interest rates are falling or low. Bullish means market prices are going up. This is an important strategy for government to stimulate the market. Reducing market interest rates can help make the investment market go up. In opposite, bond markets are bearish when interest rates are rising or high. Bearish means market prices are going down. Next, let's understand the principles of bond price behavior. Price of a bond is a function of its coupon rate, its maturity, and market movements in interest rates. Longer maturities move more with changes in interest rates. If the bond price is above par value, or YTM is below bond's coupon rate, this is what we call a premium bond. Here, YTM is the market interest rate. However, if the bond price is below par value, or market interest rate is above coupon rate, this is a discount bond. In case when the bond price is the same as par value, or the market interest rate equals coupon rate, you will get a par bond. There are some types of risk that come with the bonds. Interest rate risk is the chance that changes in market interest rates will affect the bond's value. The higher the market interest rate, the lower the bond price. Purchasing power risk is the chance that bond yields will lag behind inflation rates. That means what you earn from the bond return is not sufficient to cover the inflation. Business or financial risk is the chance that the issuer of the bond will default on interest and/or principal payments due to the failure of business management. Liquidity risk is the risk that a bond will be difficult to sell at a reasonable price. That means you might not be able to convert the bond into cash. Call risk is the risk that a bond will be called or retired before its scheduled maturity date. If the bond is called, bondholders will no longer receive coupon interest from the company. From company's perspective, bond is debt, while share is equity or ownership. There are some differences in debt and equity. Debt is not an ownership interest, while equity is an ownership interest. Buying bonds means you are a creditor, while buying shares means you are the owner of the company. For bondholders, they are creditors who do not have voting rights. But common stockholders have voting rights to elect the board of directors and make decisions for some companies' issues. Bond interest is considered as a cost of doing business, and it is tax deductible. However, share dividends are not considered a cost of doing business, and they are not tax deductible. So, using debt can help reduce the expenses of company. For bonds, creditors have legal recourse if interest or principal payments are missed. Legal recourse means the creditors are protected by law. If the company doesn't pay interest or principal to bondholders, bondholders can sue the company. However, dividends are not a liability of the firm, and stockholders have no legal recourse if dividends are not paid, which means stockholders cannot force the company to pay dividends. The last one, excess debt can lead to financial distress and bankruptcy. If company is not able to pay back the interest and principal, the company can go bankrupt. However, an all-equity firm, which means the company does not have debt as it is using 100% equity, this company will have no way to go bankrupt. Only debt will lead to bankruptcy. From an investor's perspective, compared to stocks, although bonds offer lower returns, it's still good to include bonds in your portfolio. The following are the main benefits. Bonds have a lower risk and good level of stability. For those who are conservative, bonds provide high levels of current income. Also, bonds provide diversification for a portfolio. In short, bonds add an element of stability to a portfolio. Based on the performance of stocks and bonds from 1965 to 2014, 50-year annualized return of stocks is 9.91%, while for bonds is 6.58%. The return of stocks is higher than the return of bonds. For the bond markets, bonds are traded mainly over the counter, not on exchanges. Bond price activity is remarkably stable compared to stock market. Surprisingly, bond market is larger than the stock market in the US. In many countries, bond market is growing rapidly. When the issuer first offers new bonds, that first trading is done in the primary market, where the money raised from the sale of bonds goes directly to the issuer for its use. Subsequently, in the secondary market, the bonds can be bought and sold among other investors. For the issuance of bonds, bond indentures are important. In order to issue a bond, a third-party trustee, which is usually a bank or a trust company, is assigned by the issuer to serve the needs of the bondholders, including bringing suit in the event of a default. The bond indenture, aka trust indenture or deed of trust, is a legal contract between the issuer and the trustee that specifies the scope and the responsibilities of the borrower, the trustee, and the lender. The bond indenture lists down the restrictive provisions, which are designed to protect bondholders, and describes the repayment provisions. According to Trust Indenture Act of 1939, trustee represents the debt holders. They are responsible for ensuring companies adhere to terms and covenants. And the trustee's expenses will be paid by issuing firms. In such legal contract, the indenture specifies the coupon rate, the par value, the date of maturity, the procedures to modify the indenture after issuance, the purpose of the bond issue, collateral, call provision, sinking fund provision, etc. Another important aspect is bond ratings. Bond ratings are letter grades that designate investment quality. Private bond rating agencies assign ratings based upon financial analysis of the bond issuer. There are many factors to cause favorable effect on the bond ratings, such as a greater reliance on equity as opposed to debt in financing the firm, profitable operations, low variability in past earnings, large firm size, and minimal use of subordinated debt. Generally, investment-grade ratings are received by financially strong companies. However, junk bond ratings are received by companies with high payments, but with high default risk. These high-paying bonds have a lower credit rating than the investment-grade bonds. Because higher-rated bonds have less default risk, that's why they pay lower interest rates. Sometimes, split ratings occur when a bond issue is given different ratings by major rating agencies. Institutions and investment funds managers use credit ratings provided by independent agencies, such as Moody's or S&P, in gauging the creditworthiness of bonds. AAA is the highest rating for a bond, followed by AA and A, whilst BBB is the lowest rating for an investment-grade bond. Starting from BB, these would be junk bond ratings. Alright, that's all for this video. Thanks for watching. See you in the next one. Bye.